Hi guys, welcome back. In the last session, we saw this scope of the financial management module, and I had defined how it is structured, and we completed the ratio analysis part in the previous sessions. And now, in today's session, we will focus on the borrowing area, raising of capital, which will comprise of two portions, that is, cost of capital and capital structure. So I'm covering both these in today's session. Most probably this will be long and a bit difficult. So again, I might split it into two parts. Mm, for the preparation of this PPT, I have used slides which were prepared by Thomas and used in his sessions. So few of the slides I have taken directly from his PPT. Okay, let's start. Okay, so when it comes to sources of financing for a company, it is broadly classified into two parts. One is equity and one is debt. And I'm pretty sure you don't need an explanation about what is equity and what is debt at this stage. So let's move on to get into the details of it. Why understanding of uh, sources is important. So any company will have equity and debt, okay, in various proportions. So finding the right mix of equity and debt is the key decision making because that determines the value of the firm. If you are not having a right mix, then your chances are your bottom line will get eroded in paying off the debts, paying off the finance cost, or if it is not using debt at all, then you're paying high cost of equity. So in either case, it's not a good way to manage a business. So finding a right mix is very much important. uh, it determines how controlled your business is, what's the flexibility you can take in terms of what projects to enter into, what projects you have to reject because the financing options are not matching with the requirements of the project, etc. So, for all these reasons, knowing the sources of finance, the mix of equity and debt, and the cost of debt and cost of equity and overall weighted average cost is very much important. So that's the reason of having this chapter in financial management because it's a very important thing to focus on for a finance manager as to what mix to maintain and what cost of capital they can afford to pay. Again, this we have already discussed in the ratios session and it will come into play again. Understanding of leverage here is very much important because when I said there has to be a right mix of debt and equity, this is how it looks like. So this tone here will represent your business, the risk of your business, and that risk or the requirement of the funds has to be fulfilled by two parts, that is debt and equity. And if the placement of the the lever is not in the proper place, then lifting of this rock will either will become difficult or it can become impossible. So at which spot to have that, as in what is the proper leverage for your company will depends on various factors like the size of the company, the risk appetite of the owners, and what are the industry factors that are affecting your company. All that matters. So it's not a plain vanilla thing that we can just say, yeah, 60/40 is the perfect ratio to be maintained. No, it doesn't work like that. So having a proper leverage, that is the debt portion and the equity portion, is again important. So if you are confused about this slide, if you refer to the ratios explanation, I'd explained what does it mean. And I'll keep referring to this again and again because this is important portion when it comes to understanding the mix and leverage of the finances. Okay, then what is the key difference between the equity and the debt? Of course, this is again basics. The equity holders are the owners of the company, but the debt are not the owners. They lend the money, they charge interest, and take back the principal. Most of the cases. So when it comes to repayment for equity, there is no fixed repayment. They get their money only if there is profits generated in the business. But when it comes to debt, paying of interest is mandatory. Principal is mandatory or not depends on the terms of the agreement. There are irredeemable bonds as well where principals are never repaid. So, in terms of risk, we say the investors of equity take a lot of risk because they get their share of profit only if it is available after paying off the external debts. If there is nothing left, they don't get anything. So the risk that they carry is higher compared to the risk that debt holders carry. So obviously, it's if since they are taking more risk, they expect more returns. So the cost of equity is usually higher compared to the cost of debt. That's the basic difference between the equity and debt when we talk about mix of finances. Okay, then we come to what is cost of capital. So cost of capital is the expected returns that both the debt holders and the equity holders expect from the company. Okay, it also represents the opportunity cost that they are missing out by investing somewhere else. So let's say if investor is having some funds and he has option of investing somewhere at 9%, and if you as a company are going to him and asking for the funds, then his first reaction would be basic one is I am going to miss my 9% there. So what I want from you is minimum 9% and more depending on what kind of risk I am getting into. So then cost of capital also means not only means what uh, as in from terms of from the perspective of the investor, it is what they are expecting from the company in which they are investing. And from the perspective of the company, it's the cost which the company is okay to pay, as in acceptable level of cost that they are willing to pay. That's the cost of capital. So in simple terms, it is the price that the business pays to use other people's money. And if company can't earn more than that by investing in the project, then it's not worth investing in that project. So it comes back to the NPV thing. When we calculate a NPV for a project, you remember you discount the cash flows with a rate of interest. That rate of interest is cost of capital. So when you discount the cash flows, bring it to present value and match it with the current cash outflow. And if you have a negative NPV, then you decide you don't want to take the project. That actually means the cost at which you are getting your finances is more than the returns that you are getting from the project. So you are rejecting the project. That is what it means. Okay, we'll get into further details. This is just a overview as of now. There's a lot of depth to this topic. Okay, some missing slide here. Just a sec. Okay, sorry. So now that we know what is cost of capital, let's move further and bifurcate it. So when we talk about cost of capital of a company, it includes two parts, that is cost of debt and cost of equity. Now we will first focus on cost of debt. And within cost of debt, there are two types of debt. That is, one is redeemable debt, one is irredeemable debt. We'll get into details later. And once we're done with that, then we'll move on to equity. Okay, why does cost of capital matter? So, cost of capital matters because it helps in making a decision about the projects, whether the project should be selected or not. If the cost of finance is more than the returns on the project, reject the project, which means project is not giving the sufficient profits to not just finance the not pay off the finance cost for the fundings that you are raising. Then it also sets a minimum hurdle rate for uh, the company, as in the management gets a target. At least they have to earn this much return, otherwise the bottom line will not be able to make happy to the funders, as in the people funding the company. Then it helps to calculate the net present value because the cash flows, the rate at which they are discounted and brought back to the present value, that rate is determined by the cost of capital of the company. Then it impacts the value of the firm. Like if you have a if you compare two firms, and if a cost of capital of one firm is higher than the cost of capital of the second, naturally the value of the firm will be different. The higher the cost of capital, lower is the value of the firm. Why is it so? We'll get into details. When we look at the formula, you will realize why value and cost are inversely correlated. Okay, so now getting into the details of what is cost of debt. Cost of debt is the amount that the debt owners expect, or the cost that the company pays to the debt holders for borrowing money from them. Now, to understand this, we will first take a very simple example in terms of numbers, and we will just look at a bond for 1 year. Okay, then we will slowly develop on it. What if the number of years increases, etc. So, for 1 year bond, okay, if the face value of a bond is 200,000, coupon rate is 6%, which means it will pay an interest of 12,000, and the company pays tax of 20%. Now, if you remember, in the ratio analysis, we prepared a financial statement in certain format, and we saw that interest comes above the tax. Okay, that I explained that it is a tax deductible amount, which means you get tax benefit when you pay interest. So, the tax rate is 20% for the company, and this bond is for 1 year. The question is, what is cost of capital of this bond? So, to calculate that, what we do is, this is the cost that the company is bearing, but out of this, 20% will be the benefit which we get due to tax savings. So, to remove that benefit, as in to subtract that benefit from the cost, we multiply it with 1 minus tax and divide this by bond value, and this gives us 4.8%. So, apparently, if you look at it in the in a first view, you'll see it's a cost of 6% to the company, but that's not true. The real effective cost of capital is 4.8%. So now if you look at the definition of cost of debt, it says the effective rate of interest that the company pays on the borrowing. So this is cost of capital for the debt, and it is denoted by KD. Okay. Now, the question is, Okay, this you saw, it's not 6%, it is 4.8%. Okay, the entire calculation is written down here. The question is, will this 200,000, the value of the bond, and the cost of 4.8%, will it always be the same if the number of years increases from 1 year to multi-year bond? Let's look at it. So, now we are talking about redeemable bonds, okay? We will discuss about the types of the bonds as well at a later stage, what all types of bonds are there. For now, you understand it as a redeemable bond. Redeemable bond is the one where the company collects the money at the initial stage and they issue a bond. A bond means a paper which is on which it is written that the company is borrowing the money, and on the face of that paper there's a value called face value, and it also mentions the coupon rate, how much rate of interest the company will be paying. All the details are mentioned on the bond, and it also mentions and in how many years it will be repaid. The company will repay the principal. Now, the repayment can either happen at par, that is the same money that the company has received, it will return the same money. It can happen at discount, which is less money will be repaid, or it can happen at premium, that is more money can be repaid. Okay. So, we will look at the uh, valuation of the bond for a longer period and the redeemable bonds. So, let's say this bond has a face value of 100,000. The coupon rate is 7%, which means the coupon every year that the company will pay is 7,000. Tax rate is 20%, tenure is 5 years, and it is redeemable at par, which means 100% of this will be given back. Then, what is the cost of capital? We need to find this. Okay. So, finding a cost of capital is uh, so the to get the cost of capital, understanding the valuation of the bond is important because you remember the here we took the denominator as the value of the bond, right? In this formula. So cost and value are related. You should know one of them to find the other. It cannot be that you don't know the value, you don't know the cost, and you need to find both. Not possible. You should know either value or cost, and then you can find the other one. So here in this case, we know that uh, it's the time when the bond is being issued. It's being issued at 100,000. So that's the value of the bond, which means someone will buy this bond, invest in this bond only when they perceive this bond to be worth 100,000, right? So that's what makes the value 100,000. Okay, so if that's the value, then what is the cost of capital? So for that, we do a cash flow, discounted cash flow model. This is the 5 years cash inflow that the investor will get, and in the end of 5 years, the investor will also get back the principal, which is at par 100%. Okay. Now, we can look at it from the investor's perspective and also from the company's perspective. But this module will be focusing on from the company's perspective because we will be becoming the financial manager of the company. So it's from the company's perspective. So these are the cash outflows for the company for 5 years, and this is the fifth year cash outflow of the principal. And when we pay interest, we save tax at 20% on it. So the net cash flow that we have is this amount. Now we need to discount this. Okay. So for now, as I said, we need to know one of the things. Either we need to know the cost or we need to know the value. So for this example, we will say we know the cost and we will find the value. In the next example, we will know the value and we will find the cost. Okay. So let's say here expected value of return. is 5.6%. Okay. It's just a random number. Okay. I can see that it will give some logic what I'm trying to explain. That's why I have taken this. We can take any other number, doesn't matter. Okay, so let's say if this is the expected return cost of capital, then how will we find the value of the bond? So the formula is 1 divided by 1 plus R raised to the number of years. Okay, so track this, multiply the net cash flow with discounting factor, track this, and the present value is sum of all the cash flows. Okay, so we get a value of 100,000. What does this mean? Now let's try to interpret this. Okay, it means if a investor, or from the, let's again talk about from company's perspective only. If the company thinks, if the finance manager thinks that the market would be happy with, the investors would be happy with 5.6% of return, then his offer of 100,000 for a bond will be accepted by the people, right? If let's say this expectation of him is wrong and people in the market expect 7%, not 5.6%, so people will offer him only 94,260 for this bond. So if he offers the bond for 100,000, his bond issue process will be a failure because the yield people expect is 7% and he is giving it at 100,000, and this cash flow is giving a present value of 94,000. People will not invest. So that is why the expectations, knowing the expectation of the investors is also important task, and it involves many factors. Will not get into it. Okay, so now how did we calculate this in this manner? How is it denoted in terms of formula? It is here. It says coupon divided by 1 plus r raised to t, where t starts from 1 and ends till the n. And the f means the redemption value at the end of the term tenure, and that is again discounted by the nth year of discounting factor, and then add this both to get the value, right? So there are four factors involved here. One is coupon, one is redemption value, one is bond value, and one is rate of interest, as in the yield or cost of capital, you say. So when these out of these four, if you know any three, you will be able to find the fourth. If you don't know two out of it, you will not be able to solve the question. Okay. So if either of it is missing, you can find if the other three are known to you. So in this example, what we did is we did not know the value. So we found the value. Now we will see how are these two correlated, as in cost and value. You see, cost is in the denominator while finding the value, which means if cost increases, obviously the value will go down, right? That is why cost and value of the bond are inversely related. So, for example, right now, if cost of expected return is 7%, the cost is value is 94,000. Let's say I take it to 4%. See, cost reduces, value increases. Cost increases, value reduces. Similarly, coupon is in the numerator. So obviously if coupon increases, value will increase. Like here, instead of 7%, if company gives 9%, see value increases. If instead of 9%, company gives 5%, see value reduces. So coupon and value are positively correlated. Cost and value are negatively correlated. Simple. Okay. Now let's see impact of change in expectation. This is what I explained here. I had prepared this separately as well. If you uh, change the expectation, the cost of capital, if you reduce this, your value will increase. If you increase this, value will go down. Similarly, the redemption value is also in the numerator, so it is positively correlated. If this goes up, the value will go up, just like here. Instead of 100%, if you redeem the bonds at higher value, then let's say 120%. So this increases from 101 to, sorry, 120%. So it increases from 101,000 to 108,000. So now you know the correlation between all the four factors. Coupon and redemption value are positively correlated with the bond value. Cost of capital is negatively correlated with bond value. Okay, what happens with the zero coupon bond? Okay, so zero coupon bond are the bonds where the company do not pay regular coupons every year. They just take money at the start, and there's no transaction for next few years. Depends on the tenure of the bond, and at the end of the tenure, they repay the principal with a higher amount, not the basic principal. So let's say the bond value is face value is 100,000. Coupon rate is obviously zero because zero coupon bonds. Tax rate is again 20%. Tenure is 5. Redeemable at 100% par. What is the cost of capital? Okay. So here again comes, if you know the present value, you can find cost. If you know cost, then you can find value. So here we will take the cost as 7% and see. The formula will remain same, okay, even for zero coupon bond. Just that since your C is 0, this entire thing becomes 0. What remains is this redemption value divided by 1 plus R raised to n. So here in zero coupon bond, all of this becomes 0. Okay. What remains is this portion. So if the investors expect 7% and we take a discounting factor of 7% for 5 years, then the value comes as 71,299, which means if the company is issuing this bond for this value, then it will be successful. People will be investing in it because it's meeting the expectation. But if they try to issue it at 80,000, let's say, people will not invest because expectation is 7. And if you put 80,000 here, this will go down. This will not be acceptable, right? So now, in all the examples we saw, what we did is we knew the cost of equity, as in cost of capital, and we tried to find the value here. Similarly, we knew this, we found the value. Even here, we took the cost of capital, found the value. But what if the case reverses? We know the value, but we don't know the cost. Then in that case, how to find the cost? So let's try this. How to do? So let's say the fresh example is again bond value 100,000, coupon rate is 7%. So obviously it is coupon amount is 7,000 per annum, tax rate 20%, tenures 5 years, issue price is 95,000. Okay, I've changed the numbers now. So the company is issuing the bond at 95,000. The face value is 100,000, which means on the face it's written the bond is 100,000. So the coupon will be paid on the face value. But while collecting money from the investors, they will collect only 95,000. But at the end of the tenure, after 5 years, while redeeming, it is again redeeming at 100%. They will repay 100,000. So the question is, what is the cost of capital here? Now we know the present value is 95,000. Okay, present value is known 95,000. We need to find cost of capital. How do we do it? So for that, let's remove this. Okay. Let's remove this. And so what we'll do is first we will assume a cost of capital. Okay, let's take anywhere near to this number. Let's take 7% only. Okay, we can take any number. Okay, this method is called trial and error method. We can find the cost of capital only by trial and error. The first trial that I am taking is 7%. You can take 8, you can take 6, doesn't matter. I am taking 7%. Okay, if 7%, then what is the discounting factor? 1 divided by 1 plus 7%. I'll freeze this. Okay, raised to 1 and I'll drag it here. And the discounted cash flow would be this into this. Drag it. What is the value that we get? We get 94,260, which is less than this. Okay. Company is issuing at this, but we got a value of this, which means this rate is slightly higher than the real one. We said the rate cost of capital and value are inversely related. So if we want to increase this to 95,000, we will have to reduce this number. Okay, that's when it will increase. So for now I am pasting the value here. Okay, and I'll say this is for 7%. Now let's do it for 6% and see what it happens. So with 6%, how much is the value? 98,315. Okay, this is for 6%. So the real value is somewhere in between 95,000. So the actual cost of capital is between this 6 to 7. So how to find it? So we will say the difference here is this minus this. And for 1% change, 1% change, we get this as a difference. So how much difference do we actually need? We need 7% to this. We need a difference of 740. But when we change by 1%, we get a difference of 4050. So how much should we actually change? We'll do cross multiplication. This into this divided by this. And what we get here is 0.18. So instead of reducing 7 minus 1 to get 6, let's reduce 7 minus 0.18, which is this minus this. So this should be the cost of capital, 6.82. So if we put 6.82, is it 6.8175? Let's put 6.8175 here. Now take this. See, very close. This is rounding off error. Only 15, 16, I guess. This minus this. Yeah, 16 is the difference. So the real cost of capital is 6.82. So what was the purpose of all this calculation? We knew the value of the bond, but we did not know the cost of capital. How to find? Trial and error method. Take one assumption, then take another assumption, see the difference, what's the impact, and calculate this. This is called IRR method of finding the cost of capital. This was everything about redeemable bonds. Now we will talk about irredeemable bond. So in irredeemable bond, again the formula remains the same, but there is slight difference. Okay, we'll look at the formula here. So in terms of irredeemable bond, let's take an example. This is 100,000 face value bond. Coupon rate is 7%, which means 7,000 per annum. Tax rate is 20%. Tenure is not applicable since it is irredeemable. Principal will not be repaid. Uh, of course, since it's not being repaid, redemption doesn't matter. Then what is the cost of capital here? Again, the theory remains the same, concept remains the same. Either you should know the value to find cost of capital, or you should know cost of capital to find the value. It cannot be a case where you don't know both of it and you need to find something not possible. Okay, so for this example, let's say we already know that cost of capital is 8%. So what is the value? So value in this case means this minus into 1 minus tax. This is the real cost and this divided by 8%. This is the value of the bond. So even though bond's face value is 100,000, but the value of it is 70,000. No, why? Because coupon rate being offered is 7%, and after saving taxes, what actually gets paid is 5,600, but the expectation of the market is 8%. You see, the cost, if increases, the value reduces, right? Now, the same thing is written as a formula here. Interest 1 minus tax divided by KD. KD is cost of debt. So irredeemable is simple. No cash flows, discounting, etc. It happens by a simple formula. Okay, this was about the debt valuation and calculation of cost of debt. Get back to our PPT. Most of the slides I have explained directly in Excel, so we will move on. This is the type of debt. We will get back to this in a moment. Bond valuation, why it matters? Because let's start from here only. Okay, so type of long-term debts in debt instrument. How many types of debts instruments do we have? Number one, there is simple bank loan. We get into a loan agreement, borrow from the bank. Then there are redeemable bonds that we spoke about. Then there are irredeemable bonds, even that we talked about. Then there are convertible bonds. Convertible bonds means on the face of the bond it is written that after a certain number of years, either you will have an option or it will be mandatorily converted into equity shares. So and so number for so and so value. So those are convertible bonds. Then there are zero coupon bonds, which we spoke about that they don't pay coupons. Then there are junk bonds. Junk bonds are issued by the company whose credibilities are very low. They are loss making, very high risk companies. So their value is very low, but they want to raise funds. So they issue junk bonds. Junk bonds are very risky because if you invest in that company and the company goes bankrupt, there's no there's probability that entire of your money will become zero. Okay, so in that case, since the risk is high, obviously the returns is also very high. Then comes securitization. Securitization means it happens in generally in financial institutions where, let's say, a bank has issued loans to many loans, right? Out of that, if a certain category of loans, bank combines them, makes a category, and sells of those loans to ARC, Asset Reconstruction Company. So that is called securitization. And also, it's like instead of selling it, what they do is they make a club all those uh, and issue securities, issue bonds against those assets. So when bank gives loan, it is an asset, right? To collect, they have to collect money back from the borrowers. So against that asset, bank borrows further loans. So that is securitization. Then there is Eurobond. Eurobond should not be confused with the name Euro. It has nothing to do with Euro. Eurobond is when a company issue bonds in their own country with a different currency. Like in Ireland, if a company issues bonds in USD, then those bonds will be called as Euro bonds. So these are the types of bonds we have, types of debt instruments we have. Now, why knowing bond valuation is important? Because uh, if you don't value your bond correctly, your bond issue process will go failure. And if you don't provide proper coupons, the proper yield or cost of capital to the investors, they will not be interested. So yes, bond valuation is important. Then knowing KD is important, cost of debt is important because your overall cost of the capital depends on it. And your overall cost of capital will be the benchmark for deciding whether you accept a project or not. So all these reasons are the reason why knowing cost of capital, cost of debt is important. Then all this we already covered in the Excel sheet, that is valuation of redeemable bonds, how we do it. So if you revisit this video and the Excel portion, all of that is mentioned here. The IRR method also, we saw it on the Excel. I mentioned it here. So that's the summary of the entire redeemable bonds and cost of debt. And irredeemable bond is also what we have already covered in the Excel. So from this, the left hand side is already covered. We understood what are the types of debt are there, how to value a redeemable bond, what are the cost of, how to calculate the cost of capital for redeemable bond, valuation of irredeemable bonds, and cost of capital for irredeemable bonds. Now we will look at the equity side of it. So when it comes to equity, there are two schools of thoughts. One is one says that the valuation of the equity should be dependent on the amount of dividends that they pay. And the other school of thought says the value of equity should depend on the risk element that is involved. Okay. So we will try to understand both of them and get into the details. Fine. So as I said, the cost of equity is the return that is expected by the shareholders from the company, or from the company's perspective, the final cost that the company is bearing to hold the equity shareholders with them. That's the cost of capital. And there are two main methods. One is dividend valuation model, and second is the risk-based model. We'll first focus on dividend valuation model, then we'll go to the risk model. The first one is with the assumption that what if a company keeps giving a constant dividend, one same amount of dividend every time. Let's look at it in the Excel. How does it look? So dividend is, let's say, zero point 0.4, price is 2.2. So again the story remains the same. You should either know the price to get the cost, or you should know the cost to get the price. Okay. Now, this looks like a similar case to irredeemable bonds, right? You don't get your money back unless you sell your shares. You keep getting dividends, just like irredeemable debt, where you keep getting your interest for your lifetime. So the formula is similar, right, to the redeemable debt. Only the change is, instead of interest, we get dividend. And if you remember in the ratios video, we saw the financial statement, profit and loss. The interest was above the tax, but the dividend was below the tax. Dividend doesn't get a tax benefit, only interest does. So this 1 minus tax loses its relevance, and the KD becomes KE. So the formula then becomes value of equity is equal to dead dividend upon cost of equity. And if you want to find cost of equity, then this KE goes here, and this is mathematical calculation. V comes here. So cost of equity is dividend divided by value. So in this case, value will be simply dividend divided by the price, 18.8%. Okay. So this is the basic formula for in case where the dividends are constant. You are going to get the same dividend every year on year on year. So this is the cost of equity, and that's the price. Uh, Now let's say if so this was the initial traditional valuation method that came into play. Then there was one Mr. Gordon who came into the picture who said the dividend doesn't remain the same. Company grows. So there is a growth rate involved. Okay. And the value of the equity should embed the growth element into it. It cannot be isolated. So let's look at it with the example. Let's say current dividend which was paid in this year right now is 0.27, and the expected growth rate every year is 5%. Okay. Price is price of the share is 3. Then what is the cost of equity? Again, same. If you know this, you can get this. If you know this, you can get this, but you should know one of it at least. Fine. So here let's find cost of equity. How do we do it? So he gave his own formula. He has done his research and he brought his formula. He says that price of the share today, right now, will be D plus 1G, which means dividend, expected dividend of next year. Okay. How do we get it? The current dividend plus the growth rate. That's what we expect next year. Divided by the cost of equity, which is same like the irredeemable debt here, divided by cost of debt. So similarly, divide by cost of equity, and then add the growth rate to it. That will be your cost of capital. So with this formula, in the current scenario, we know the price. We need to find KE. So let's replace all these numbers. So price becomes 3. Dividend of next year is 20.27 plus 5%, which is 0.2835, divided by KE, which is not known, and growth is 5%, which is 0.05, which is here. Then KE goes here, this 3 comes down. This is how it happens. KE is calculated as 0.1445. In percentage terms, it is 14.45%. So KE is 14.45. So this is how Gordon spoke about the valuation of equity and uh, cost of equity. Okay, let's get back to the PPT. Yeah, so Gordon spoke about this, okay, which is more realistic because yes, the dividends cannot be constant forever, right? But there are still a lot of limitations to both the methods. Both methods have limitations, the traditional one and the Gordon. What are those? Number one, they assume that the dividends will grow at a constant rate. Not true. Growth rate cannot be constant, it will change, right? Number two, it doesn't work in the companies that don't pay dividend. What if the company doesn't pay dividend? How will you value those companies? Using these formulas won't be possible. It doesn't account for other returns like share appreciation price. See, in both the methods, they were only talking about the dividends as a return to the shareholders. But what about the change in price? The appreciation, the value of shares, they ignored. Both the formulas ignored it. But in still few, if the company is stable, right? If very large organization which is already well established and there is no plan for further vast expansion or something, they are stable, matured company. In those cases, these formulas still work. Okay, so we were here, and in the equity part, we covered dividend based. Now we are moving on the risk based part. This is slightly important because it is relevant in the real world as well. Okay, when we talk about risk based model, so there are two types of risk which the shareholders bear. Okay, one is systematic risk, one is unsystematic risk. Systematic risk are those which are relevant to the entire market, just like COVID. When COVID came, entire market was impacted. Okay. Uh, but unsystematic risk are company specific risk. Like there's some fraud news in the company, price goes down for only that company, it doesn't affect the entire market. Unless it's something like Lehman Brothers or something that the crash is so huge and the volume is so high that entire market is impacted. Generally, it doesn't happen like that. Then let's say if a company is giving bad results, that company prices go down, not the entire market. So those are unsystematic risk. Systematic risk are those which are applicable to all the companies in the market. So then how can we manage this risk? When it comes to systematic risk, we can't manage it. We can't manage. And then in reality, the portfolio managers do manage it by investing in some other assets like gold, bitcoins, this and that to manage those. But for theoretical purpose, systematic risk cannot be managed. Unsystematic risk can be managed. How? Investing, diversifying your investment in various companies, not sitting in one company. If you diversify your entire amount in many companies, then even if one company performs bad or the unsystematic risk comes into play, it will not impact your entire portfolio. So your risk gets diversified. So why knowing this is important is because in the calculation, theoretical calculations, the formulas, uh, the shareholders don't get any premium if they own unsystematic risk, because that risk is avoidable. If you have not avoided it, it is your mistake. So the market does not offer you premium for bearing unsystematic risk. You get premium only for the systematic risk that you have. Okay. So when we say premium, what does it mean? It means if you go and invest your money in a bank, in a fixed deposit, you get a certain rate of interest. But if you go to share market and you invest in the index like Dow Jones, Nifty, so the return that market gives is higher compared to the return which the bank gives. Why? Because risk is higher. This is risk free. So you get risk-free returns. But when you're taking risk of putting your money in the market, the expected returns are higher here. So the difference between the two is called the premium, risk premium that the investor get for putting their money in the risky area compared to the risk-free area. So these are the risk which we will talk about. Now we will go for the valuation of equity on risk-based model. Okay. So there is one model called capital asset pricing model, which is very important. It is used in real life as well. When do we use this? Number one, when company does not pay dividend, you will not be able to use those dividend based model. Number two, uh, you want to factor in the risk that the shareholders are bearing when they hold the shares. That's when you use capital asset pricing model. So what are the factors involved here? There are three things involved in this formula. One is risk-free rate, one is beta. We will understand what is beta in next few slides, and there is market returns. Okay. So let's understand beta here. So beta is, as we spoke about the like systematic risk like inflation rates, COVID, etc., recession affects entire market, right? We said that these things impact entire market, but the question is the impact same on all the companies? No. So the change of prices are different for different companies. Impact is there, but the strength of the impact is not same for all, right? So what is that factor, that the impact of that risk on particular company is called beta, right? Uh, to calculate that, what we do is we take correlation of change in price of a share compared to the change in price of the indices. Like let's say, if we say US market, we have Apple as a share and we have Dow Jones as their indices. Okay, and we correlate them and we see when, on an average, when Dow Jones goes up by 100 points, or let's say 10%, Apple goes up by 12%. So which means the beta of Apple is 1.2. So it moves 1.2 times in the same direction. If it is minus 1.2, it means inverse correlation. If market goes up 10%, Apple goes down 12%. Then the beta is minus 1.2. So that factor is beta. The comparison of correlation of change in price of the stock with the market. So if correlation is positive, beta will be positive. If correlation is negative, beta will be negative. The extent of correlation of beta is the value of beta. For example, if market goes up by 10, stock goes up by 13, then beta is 1.3. How do we get it? 13 divided by 10. If market goes up by 10, stock goes down by 16, then beta is minus 1.6. So these were the three things. Okay, we spoke about beta. The first item is risk-free return. Risk-free return, where do we get it from? The bank, government bonds. Uh, if government issues bonds, then what is the rate that you will get? That is risk-free. You will definitely get that. There's no risk involved. So that is the risk-free return. If you invest in market, when we say market, it is the indices. Okay, it is the bucket of all the top shares. If you invest in the indices, the rate which you will get is the market return. And the difference between the market return and the risk-free return is the risk premium. And the beta is the extent to which there is change in price of the shares compared to the market, right? If beta is more than 1, it means the share is more volatile compared to the market. If beta is less than 1, it means share is less volatile than the market. Like if market goes 10 point up, 10% up, and the stock goes only 4% up, which means beta is 0.4, which means the volatility of stock is less compared to the volatility of the market. And if it is 1, which means they are moving the same direction. Okay, let's go on deriving the formula. Let's derive capital asset pricing model. So let's say if risk-free rate in the market is 3%, if you invest in government bonds, you get 3%. And the stock which you are talking about, it has a beta of 1.2. Okay. And market provides a return of 10%. So in that case, what is the cost of equity of the company which you are trying to invest into? So how do we expect the return is? Firstly, Bare minimum we want is 3% because government is offering 3%. So we take 3% here. Then in addition to this, we are taking risk. So for that we need risk premium. Risk premium is market return minus the risk free return, which is zero point 0.7. But we are not investing in market here. We are investing in a stock, and that stock has its own volatility compared to the market. So we take beta. So we multiply that beta with the risk premium, and then we add the risk free rate to it to arrive at the cost of equity. So risk free plus beta into risk premium is the formula as per capital asset pricing model to arrive at the cost of equity. Okay. And same thing I have written here, nothing different. What are the pros and cons of this method? So, okay, so both the dividend, just a sec, I guess I missed a slide. Okay, so what are the pros and cons of capital asset pricing model? Number one, it considers the systematic risk, which the dividend model was not considering. Number two, it is useful when there is no dividend being paid by the company, but company is obviously working hard and making profits. So the value of your equity goes up. So there has to be a way to calculate the cost of capital for the cases where the company don't give dividends. So dividend model will not be helpful. Capital asset pricing will be helpful. And it is widely being used in real world as well. What are the limitations here? It it assumes that all the investors behave the same, right? Not It's not true. But as of now, there's no better method than CAPM to value equity, so this is being accepted. Number two, it is based on historical data. So when we talk about risk premium, we said that return of the market subtracted by the risk-free return. The return of the market which we calculate is based on historical data. Number two, the beta was calculated based on correlation of market with the movement of shares. That is calculated based on historical data, which may or may not be true for future, right? And it assumes only one type of risk, which is market risk, that is systematic risk. It ignores unsystematic risk, assuming that the investors are diversifying their portfolio, but that may not be true for some investors, right? So these are the pros and cons of CAPM. Then comes the DVM versus CAPM, that is dividend valuation model versus CAPM model. And we saw that dividend model can be used only when company gives dividend, and it is useful when the company is a mature company who has reached certain stage where they're generally like a government companies who are large government companies of India, especially like Coal India, GAIL, etc. Oh, they just keep continuing their operations, make money, give dividends to the governments and the other few shareholders that they have. Majority of it is held by the government, right? So in those cases, yes, dividend valuation model helps. But if company is retaining a certain chunk of their profits for further capitalization, further investment in machineries, new projects, expansion, etc., then only valuing a company based on the small dividend that they are giving it's irrelevant. Not doesn't make sense. So that's when capital market comes into play. CAPM comes into play. And CAPM reflects the risk more accurately compared to beta, via its beta compared to the dividend model. Now comes the story of working weighted average cost of capital. Now we learned cost of debt, we learned cost of equity. Now comes the weighted average cost of capital because every company has funds which is a mix of debt and equity. It's very rare that company has only debt or only equity. There's a mix. And if there is a mix, there has to be an overall average cost of capital for the company. Why do we need to know it? Because that will be the cost of capital that will be used for discounting the cash flows of the project to decide whether the project is profitable or not. So we cannot take just KE, we cannot take just KD. We have to take a weighted average of it. So, how do we do it? We add proportions or weights to both the cost of capital, cost of debt, and we find it. Let's see it in Excel here. So, let's say a company has market value of its equity as 20 million, billion, whatever you want to consider, and debt is valued at 16. So overall it is 36. And the cost of capital before tax for equity it is 12%, debt it is 6%. How did you get this? From the formulas which we learned. Calculation of cost of debt. So we knew the value, so we calculated the debt cost. Now we know both, and we know tax rate is 20%. So after tax cost of capital would be equity will be same because there is no tax benefit on dividends, but debt will reduce because there is tax benefit. And we allocate weights to it. How do we allocate weights? It is how much percent 20 is of 36. 20 divided by 36 into 100. So 56% is equity, 44% is debt. We allocated this weight, we multiply these two, we get weighted average cost, we add these two, this is the weighted average cost of capital. What is this? What is the relevance of this? Now when we have these funds, we will go into the market, we will go to bid a project. We will discount the cash flows of the project using this rate, 8.83. And if the NPV is positive, which means that project is able to repay these funds, finance cost, so we will take the project. If the NPV goes negative, which means the return of the project is less than 8.83, we will not go with the project. So the same thing I have mentioned here, nothing new. How to calculate steps, again, what we did in Excel is mentioned here. Same example is mentioned here. Okay, limitations of weighted average cost of capital. It assumes that the capital structure will remain constant during the project life. So when we took that rate and we discounted the entire cash flow of the project with that rate, the assumption is for the entire life of the project, the cost structure will be the same, which is rarely true. Number two, it assumes that the current the project risk is equivalent to the company's average risk. Like, for example, you found out that your weighted average cost of capital is 8.83%. Okay. Now you are discounting the cash flows just based on 8.83%, ignoring the fact that the project in which you are involving, we are planning to invest, that project can have multiple other risks as well. That could be any risk, as in the local people over there, where you want to execute the project, they can be a hindrance to the project, or there are many other kind of risk involved. All those are ignored. You just discount the cash flows and see uh, whether your NPV is positive or not. So it ignores all those other risks. Number three assumes that all the funds raised are in the same proportion, which means during the tenure of the project, let's say you are investing in a 10-year project, and during that project you need further funds. So it is assumed that the mix of equity and debt will remain the same, right? But that may not be true. Your mix will change. So again, that's a limitation of WCC because we took the cost of equity for all the cash flows, right, for the next 10 years. But if our mix changes, the cost of equity will change. So that's a limitation. It doesn't handle a variable interest rate or changing market values well. So once you get a WACC, right, based on what you have currently. Now, after this, tomorrow morning, central government reduces the rate of interest. What happens? The value of your bonds will change. The cost expectation of the investors will change. So then you'll have to again calculate WACC. But you have already used that WACC and calculated the NPV. So the change in interest and the change in value is not considered by WACC. That's a limitation. But there's no better method as of now. So this is used by the companies mostly. So here it comes. WACC depends on the cost of debt and cost of equity. Cost of debt we learned how to calculate for redeemable and irredeemable. For the equity we learned it for dividend based model and the risk based model. We covered all of it. Now we will go to capital structure theories, which means as of now we were talking about cost of debt and cost of equity. Now we will talk about the proportion of equity that we should have against proportion of debt to have maximum profit. Let's cover this in part 2 video.